According to research consultancy Nielsen, 57% of consumers worldwide believe they're currently in a recession, and at least half of this group believe this will carry on for another year. Now, on the back of this, returns from different asset classes are expected to be lower for longer. Local asset manager Marriott has noted that there's been a shift of funds out of money market funds, that's into balanced funds. Duggan Matthews, portfolio manager at Marriott Asset Management, joining us. Duggan, thanks so much for joining us. So just looking at that shift, according to the latest ACESA numbers, you've got an outflow of 44 billion rand from money market funds and 47 billion rand moving into balanced funds. So it pretty much matches there. What do you say is the key driver of this?
Yeah, it's the first question that springs to mind is why the change in that type of investor behavior. You know, looking back over the last 10 years, we haven't seen that type of outflow from money market funds. In fact, we've seen steady inflows. But in the beginning of 2011, it's all turned around, and we've seen a lot of what it appears that a lot of that money has been directed into balanced portfolios. It's quite difficult from a market valuation or an investment fundamental perspective to justify that shift currently. If you look at the yields of South African long bonds, they're sitting at 7%, which is probably the lowest they've been for the last 40 years. Equity yields are sitting at 3%, which is about 1.5% below the historic average of that asset class. So if you look at those quite low income yields from those investments and you compare it to those significant flows going into balanced portfolios, which are predominantly comprised of bonds and equities, you kind of end up asking why the change of investor behavior now. And I think the major driver at the moment relates to the very low interest rates on cash in the bank. You know, the interest rates today is at the lowest level it's been for 38 years, which is having an impact on where investors are choosing to invest their money. We just think it's important for investors to be aware that market valuations currently aren't attractive. And the investment fundamentals underpinning, a bond investment and an equity investment, just looking at that survey we were chatting about in the intro to the show, are not that great either.
Mm-hmm. So it's quite tough, Duggan. I mean, investors can either sit with their cash and the capital guaranteed in money market funds or with not as much risk in money market funds. Or they can then go, obviously what they're doing is they're now moving in and saying, well, we're prepared to take the risk, even at these lofty valuations, and try and chase a real yield, So it's a really tough one. Where are you guys seeing value?
Yeah, it's as you mentioned, a terribly difficult environment, specifically for retired investors who need to draw an income from their savings. 4% or 5% interest is just not enough for most people. So
certainly not protecting you against inflation if you are weighing that up.
Absolutely. So at the moment, the incentive is maybe let's take on a little bit more risk in the hope of extra return. But as I've mentioned, yields are low and market value or investment fundamentals aren't very good at the moment. We'd say, fortunately, the story offshore is completely different. You're looking at first world mega cap stocks on attractive dividend yields well above their historic averages. So we would suggest investors looking for income and capital growth from their portfolios, trying to keep up with inflation, that they consider offshore exposure, predominantly first world markets.
And you talk about these mega caps.
Yes.
Delve into some of those for us.
There's companies like Nestle on a dividend yield of 3.5%. That produces reliable growing income and capital growth as a result of that income growth. Just looking at that one example, that company markets and distributes over 8,000 different brands. It sells 1 billion products a day across 132 countries around the world. So you're buying into an attractively priced investment with a very secure income stream. There's other examples like Pfizer, Procter & Gamble, Unilever, all on dividend yields of around 3.5% to 4%, which when you consider the low inflationary environment in which those companies operate, those are much more attractive valuations.
I'm always interested, Duggan, to find out why we have these companies. I mean, we talk about these companies and they are massive. I mean, Procter & Gamble, Nestle, you're selling 1 billion products. This is not a bucket shop, and yet they're trading at these attractive multiples relative to other asset classes. Any idea why?
You know what? No, it just is presenting investors with a good opportunity. They
don't ask questions. Buy the stock.
The reality is maybe they're out of favour, maybe they're considered boring, but you're not going to get extraordinary income growth from those companies. They'll be able to pass on inflation, but you know what you're going to get. You're going to get an attractive starting yield, and you're going to be able to bank on income growth in line or a little bit of inflation over time.
When you look at these international stocks, because I think this is one of the key themes that you in fact have been talking about from Marriot's perspective for some time, maximizing offshore exposure. How do you evaluate getting exposure to these companies and in terms of their advanced economy exposure versus developing world exposure?
We take a basic approach. We just look at the price you're paying for that income stream, and we try and determine whether it's an appropriate price. And if you look at where these companies have the yields they've historically traded on, as I've mentioned earlier, they're trading at yields well above that. And if you contrast them to similar companies in South Africa, the picture is completely different. Their yields are well below where they've historically traded. So we just try and position our investors' funds in the income streams that are offering them the most value.
Just in terms of, if every investment manager I speak to these days has their full allocation offshore, where are some of the areas of value you've been finding locally?
It's hard to find much value locally, we feel. But in the equity market, if you're looking for income and capital growth there, we would suggest investing in defensive type companies that are able to produce growth and income in difficult economic conditions, because we feel that we're in for a protracted, difficult period in global economy.
So of course you're basically seeing the world slugging along for some time now, and you're hoping to choose companies that do well in that type of environment. So when it comes to that dividend growth fund of yours, this obviously would be picking those kind of companies that have that reliable income stream. Talk to us about sector positioning within that.
Yeah, I just think the long-term picture, the reality of the long-term picture from an economic perspective is difficult times. I don't think there's a quick solution to the debt problems the world is currently facing. So we're looking to, in terms of our sector allocation, positioning ourselves in defensive sectors. Telecommunications is a good example, healthcare, food retailers, those type of businesses that are able to produce growing turnover in difficult times.
Now, being an income specialist, you've also been, or you invest quite a fair portion of your portfolios in things like listed property. What's your sort of outlook for the listed property space at the moment?
Listed property, we feel at the moment, is on very low yields, especially looking back in history, and they've really tracked bond yields down, and a driver behind the current low bond yields has obviously been massive foreign portfolio inflows into the bond market. We'd say you're paying a lot for an investment into a property company at the moment, and look to avoid that asset class for now until you see better value there.
So in terms of, I understand the correlation between the listed property yields and the bond yields.
Yeah.
But obviously the properties, listed property, have the ability to grow those yields if they're buying the right assets. Is that still the case for listed properties in South Africa?
They should be able to grow their income streams, but they are also facing tough times. Their tenants are retailers and companies across South Africa, and they obviously are exposed to what is a tough economic climate. So we expect subdued distribution growth from the property sector, making a 7% yield quite unattractive.